Welcome back to Generation Gains. Today we're diving deep into one of the most crucial, yet often misunderstood concepts in investing: risk management. Every investor faces risk in some form, but it's how we manage it that makes all the difference. In this video, we're going to walk you through smart strategies for understanding, managing, and using risk to your advantage as you work towards building your wealth. Let's start with the basics. What exactly is investment risk? In simple terms, risk refers to the possibility that your investment might lose value or fail to produce the expected return. It's the uncertainty that accompanies all forms of investing. Now, don't freak out. It's important to understand that every type of investment carries some level of risk. Whether you're in stocks, bonds, real estate, or even cryptocurrency, no investment is entirely risk-free. Take stocks, for example. They can be highly volatile, rising and falling in value based on market conditions, company performance, and global events. On the other hand, bonds tend to be more stable, but even they come with risks such as credit risk or interest rate risk. Then there's real estate, where location, market conditions, and property value fluctuations can impact your returns. The goal isn't to avoid risk entirely, but to understand it and find ways to minimize it in your portfolio. So how do we do that? How do we reduce the potential downside while still staying in the game for those long-term gains? Let's break it down with some essential strategies. First and foremost, it's crucial to know your risk tolerance. This is the level of risk you're comfortable with and willing to bear. It's different for everyone and depends on factors like your age, your financial goals, your income, and your ability to emotionally handle market ups and downs. If you're young and just starting to build your investment portfolio, you might be more comfortable taking on higher levels of risk. After all, you have time to ride out the market's inevitable fluctuations. Stocks, for instance, might make up a larger portion of your portfolio, as they tend to offer higher returns over the long term, despite their short-term volatility. On the flip side, if you're closer to retirement, or you simply don't have the stomach for the roller coaster ride of the stock market, you might want a more conservative approach. This could mean a larger allocation to bonds, dividend-paying stocks, or even cash equivalents that are less prone to sudden drops in value. There are many risk tolerance quizzes available online that can help you determine your comfort level with risk. Once you know where you stand, you can tailor your investment strategy accordingly. The next critical strategy is diversification. In the investment world, the phrase, "don't put all your eggs in one basket," rings particularly true. Diversifying your investments means spreading your money across a variety of asset types, such as stocks, bonds, real estate, and international markets. This way, if one asset class underperforms, the others in your portfolio may be doing better, helping balance out the impact. For example, let's say you're heavily invested in one stock, and that stock takes a major hit. If that's your only investment, you could lose a substantial amount of money. But if you've diversified into bonds, international stocks, or real estate, the impact of that one stock loss is minimized, as other investments may still be performing well. In addition to reducing the risk of major losses, diversification also smooths out the volatility of your overall portfolio, which can help you sleep better at night during market downturns. Keep in mind that diversification is a continuous process. You need to keep reassessing your portfolio to ensure it stays well-balanced as market conditions change. Next up is asset allocation, which is all about determining the right mix of investments based on your goals, time horizon, and risk tolerance. The idea behind asset allocation is to create a portfolio that is balanced in a way that reflects your financial objectives. If you're young and planning for retirement decades down the road, you can afford to take on more risk. This could mean a higher percentage of your portfolio in stocks or other high-growth assets. However, if you're getting closer to retirement, you might want to shift some of those funds into safer, more stable investments, such as bonds or dividend stocks, that are less likely to experience drastic losses in value. But remember, your asset allocation isn't a set-it-and-forget-it type of deal. Over time, the value of your investments will shift, so it's important to periodically rebalance your portfolio to make sure it aligns with your desired allocation. Rebalancing can help ensure that you're not unintentionally becoming too risky or too conservative, as certain asset classes outperform others. One of the most important skills to develop as an investor is the ability to stay calm during market downturns. It's natural to feel anxious when the market takes a dive, but panicking and selling your investments is one of the worst things you can do. It locks in your losses and prevents you from benefiting from the eventual market recovery. Keep in mind that markets are cyclical. They go up and they go down. If you're diversified and sticking to your long-term plan, market dips are simply part of the ride. In fact, they can even present buying opportunities, allowing you to purchase quality investments at a lower price. So instead of making rash decisions during downturns, focus on the long term and stay committed to your strategy. Another key aspect to remember is that markets have historically recovered from downturns. While past performance isn't always an indicator of future success, history does show that the markets tend to bounce back over time. If you're in it for the long haul, the market dips are just temporary setbacks on the path to future growth. One of the most effective ways to manage risk is by using low-cost index funds and exchange-traded funds, ETFs. These funds offer broad market exposure, which helps to mitigate the risk of putting all your money into individual stocks. By investing in a fund that tracks an entire market index, such as the S&P 500, you gain exposure to a wide range of companies, sectors, and industries. Low-cost funds are also much more cost-efficient than actively managed funds. They typically come with lower fees, meaning you keep more of your returns. Over time, those savings can really add up, and the lower fees allow more of your money to stay invested, working for you. Plus, index funds and ETFs tend to be less volatile than individual stocks, which further helps to reduce risk. Instead of betting on one company, you're betting on the overall market, which tends to provide steadier returns over time. So to recap, managing risk is all about understanding your risk tolerance, diversifying your investments, using asset allocation to balance your portfolio, staying calm during market downturns, and minimizing costs with low-fee funds. These strategies will help you manage risk like a pro and stay on track toward building long-term wealth. Remember, risk is an inevitable part of investing, but with the right approach, you can manage it in a way that maximizes your returns and sets you up for financial success. Whether you're just starting out or you're a seasoned investor, these strategies will help you navigate the ups and downs of the market while keeping your eye on the prize: financial independence. Thanks for tuning in to Generation Gains. If you found this video helpful, make sure to like, subscribe, and hit the notification bell so you never miss a new strategy or financial tip. And remember, investing isn't about avoiding risk. It's about managing it wisely so you can reach your wealth-building goals. See you in the next video.